we've made it through the historically difficult month of September better than ever, which is great, except now we need to contend with the historically horrible month of October. Last month, we got bailed out by the Fed's double rate cut. But there's no open market committee meeting this month, and we just got a very strong labor report that's making Wall Street wonder if we'll get another rate cut at the next meeting in early November. And interest rates just flew today. Tricky situation. One made more difficult by the fact that the averages are still within spitting distance of their all-time highs. It's tough to get enthusiastic about new ideas at a moment like this, especially with earnings season about to kick off at the end of the week. PepsiCo, by the way, starts tomorrow. But there are some stocks that can absolutely work in this environment, which is why we spent the weekend sorting through the S&P 500, searching for names that met three simple criteria: yield, earnings growth, and value. I call it YEV. YEV. First, we want stocks that offer better yields than you can get from the benchmark 10-year Treasury, which is currently a little over 4%. Second, we want outsized earnings growth, meaning better than the 14% growth Wall Street's expecting from the S&P 500 as a whole next year. Finally, we want value, meaning stocks that are cheaper than the S&P 500 in the aggregate, which currently trades at roughly 21 times next year's earnings estimates. You know what? That's actually a very tough set of criteria. But it gives us a list of 9 YEV names that I plan to unveil over the course of the week. Now, I want you to think of them as the elite of the elite. Not many companies can give you high yields, cheap stocks, and explosive earnings growth all at the same time. So I want to start with the two that have the highest yields, both of which are big commodity chemical plays. I'm talking about LyondellBasell, that has a 5.62% yield, and Dow with a 5.13% yield. Of course, these two chemical stocks haven't been doing particularly well, but they're effectively flat for the year, trailing the S&P 500 badly. That's up nearly 20% over the same period. And look, LyondellBasell and Dow both deserve to be laggards this year. These are textbook cyclicals. They boom when the global economy booms, and they lag behind the economy struggling. Until very recently, the two largest economies of the world, the United States and China, were both deteriorating. But think about what's happened just in the past few weeks. First, the Fed officially kicked off a new easing cycle, starting with that double rate cut I just mentioned. And then there's a clear consensus that we are going to get several more rate cuts done before the Fed is finished. Wall Street's expecting that the Fed funds rate will be down to 3.5 to 3.75% by next June's meeting. That's down 125 basis points from where it stands right now. What really matters, though, is that the general direction of interest rates is lower, which means the Fed is your friend. Don't fight the Fed. At moments like this, the textbook cyclical stocks tend to become big winners. If there's a perfect time to buy commodity chemical places like Dow and LyondellBasell, it starts when the Fed is cutting, which is right now. Second, in the past 2 weeks, the Chinese government has announced the most aggressive stimulus efforts that it's put in place since the end of the pandemic. And for once, China's actually putting money in people's pockets. For a communist regime, they seem to really hate handouts. But they're finally taking action to bolster their alien economy, which is good news both for their own companies and for cyclicals worldwide that are levered to the Chinese economy, including Dow and LyondellBasell. That's why I think these commodity chemical companies feel interesting here. A couple of weeks ago, analysts at J.P. Morgan published a note on the chemicals group, basically said that they expect these companies to report weak third-quarter results. Remember, Dow reports on October 24th, LyondellBasell coming on November 1st. We're not expecting anything here. Dow already pre-announced light numbers at an industry conference last month. But the analysts at J.P. Morgan went on to explain that these stocks have been what we call de-risked, meaning the near-term earnings headwinds are already baked into the share price. If you're willing to look past that and see further into the future, though, Dow and LyondellBasell should be on the road to recovery now that interest rates are coming down. You got to anticipate. That makes a lot of sense to me. Perfectly jives with what we heard from Jim Fitterling, the chairman and CEO of Dow, when we had him on the show back in July. Listen to this.
I think we need to see mortgage rates get to something with a 5 handle on them so that we can see people being able to get mortgages and being able to move into that market. When that happens, the part of the business that's slow will pick up pretty quickly, both from construction and then all the knock-on effect from appliances, carpets, and other things that go into the housing market.
Bingo. That's more or less the story here. Of course, Fitterling said all of this a couple of months before Dow had to issue a negative pre-announcement for the third quarter, mostly because of the hurricane shutting down production. That pre-announcement came on September 12th, causing the stock to hit a low for the year. But since that's rebounded from $50 and change to $54 and change, you expect that to happen during the rate cut season. That rebound makes so much sense. Everybody knows that when the Fed starts cutting rates, it's time to buy the cyclicals. It's just that these commodity chemical plays take a little longer to come alive again than, say, the housing stocks. Of course, Dow and LyondellBasell are very much hostage to the Federal Reserve. If you don't believe we'll get a steady stream of rate cuts, then they won't be able to hit the earnings estimates, meaning the stocks are more expensive than they look, and they could be poised for more downside. But you know what? If, like me, you believe the Fed will continue cutting, then bond yields will come down too, and economies around the world will reaccelerate, bolstering the commodity chemical business as a whole, including Dow and LyondellBasell. Well, then you got to pull the trigger. So here's the bottom line. In this quiet period before earnings season gets crazy, okay, we got to search for new ideas. These are ideas that represent the highest quality stocks for the current moment, the ones that fit the YEV paradigm: yield, earnings growth, and value. Dow and LyondellBasell, they perfectly fit the bill. And as chance would have it, they're exactly what the hedge fund playbook says you should buy at this point in the business cycle. Keep watching this week, and I'm going to give you some 7 other names that pass the very exclusive YEV test. Then Money's back after the break.
Coming up, bulls, bears, and binge watching. The 5-star case for Netflix against those who fear a flop. Next.